Insurance in every aspect is getting more expensive, even outpacing general inflation. The head of a trans-Tasman insurance giant explains why.
It gives me no pleasure that insurance inflation is sitting above CPI. It's uncomfortable, but it's necessary in terms of having a sustainable insurance market going forward.
Tropical Cyclone Jasper and Christmas storms were Australia's most catastrophic weather events in the past year, with insurance costs in the billions. While New Zealand is holding its breath to see what comes next after the anniversary floods and Cyclone Gabrielle, the cost of fixing damage from such significant events is now higher, meaning policy premiums are going in the same direction. Insurance inflation rose by 14% in this economy in the year to June, according to Statistics New Zealand. It's one of the biggest contributors to CPI increases, which has been forcing interest rates to stay high. It's also helping boost the bottom lines of the biggest general insurance players. IAG, NIB, Suncorp and Tower have all reported recent jumps in their profits. But they're also all grappling with more expensive reinsurance, effectively paying more to insure their own insurance offerings. Over the past 5 years, Suncorp, which owns Vero and AA, had to increase its hazard claims allowance and reinsurance by $1 billion Australian dollars. In New Zealand alone, its reinsurance costs grew 36% in the past year, after Cyclone Gabrielle and the Auckland floods. Since those events, its premiums here have risen by 17% on average. Suncorp Group's Australian CEO, Steve Johnston, was in the country last week, so I asked him to explain why its biggest hikes are happening on this side of the ditch. Well, Steve, thank you so much for doing this. Really appreciate it.
No trouble.
What are you doing in New Zealand?
Well, I'm over here for board meetings. So every year we have a series of board committees and board meetings. So I've been on a around the world trip, as we do at this time of year, with talking to investors, talking to reinsurers, talking to some of our suppliers. We're at a very exciting point for Suncorp, having just divested our banks. So here we are in New Zealand for a couple of days. And
about to divest your life business in this country too, aren't you?
And the life insurance business in New Zealand, part of our simplification agenda. So at the end of all of that process will be a what we call a pure play trans-Tasman insurance company, general insurance company, and that's really exciting.
We are definitely going to talk about general insurance in more detail, but I'd love for you to explain for me the different dynamics that you see for the insurance markets on different sides of the ditch. What would you say is kind of the biggest differentiating factor between them?
There's a lot that differentiates us, but there's a lot of similarities that I find. So if I quickly talk to the similarities, firstly, we all buy out of the same reinsurance markets. And those global reinsurance markets have been significantly dislocated over the past 2 or 3 years. Now, global reinsurers were happy to put their capital into Australia and New Zealand forever based on the diversification they got for the risks they wrote around the world. Unfortunately, I don't think they did enough modelling of primary and secondary peril, and they paid for it. So what we've seen is a reset in both Australia and New Zealand, and that's flowed through from reinsurers to primary insurers and then on to consumers. So it's been a very challenging time for consumers. That's one of the similarities that we have. We also have challenges around the built environment has been built in areas they should never have been built. In terms of differences, there's not a lot really. I think we offer different sort of products here in New Zealand than we do in Australia. I think I look at the New Zealand business that we have here, and it's fantastically positioned. The Vero business is well positioned. We've got a fantastic joint venture arrangement with AA. We write right up and down the vertical of insurance, where we do limited amounts of that in Australia. We've got a great corporate partner business, and we've got a great Vero liability business. So I think we are probably better placed in terms of our insurance capability in New Zealand than we are in Australia.
I definitely do want to talk to you a lot about reinsurance. We'll get there, but just on the physical environments, who's riskier from an insurer's perspective, Australia or New Zealand, and why?
Oh, look, I think the earthquake risk is always something that, that's one peril that both primary insurers and the reinsurance market have been able to model pretty effectively. So there's no doubt the shaky isles, as they call it, is one of the reasons why New Zealand is a little bit different and why that risk is sort of elevated. Having said that, we've had quite a deal of seismic activity in Australia over the past month. touch wood, that's limited to the sort of levels of magnitude that it's been. And when that happens, we actually call on our New Zealand colleagues to help us because of the experience that you've got in this part of the world.
So if I look at your premiums then, they've increased across all categories. You are one and the same. Almost every insurer that I've spoken to is doing the same thing. Home was up around 10%, commercial was up a little bit more, and then in New Zealand it was up by 17% on average. Consumer policies here were up by 23%, Steve. If the risks, in your opinion, are relatively similar, physically speaking, and reinsurance costs are one and the same, why are we paying so much more on the side?
Yeah, look, I think obviously the events of 2023 in Auckland and the cyclone that flowed after the flooding event was an uninsured, unmodelled risk. And what we saw from the global reinsurers in the immediate aftermath of that is just a pause and reflect on what New Zealand risk was. They were very familiar with earthquake risk and they'd been able to model that and price that effectively. But the flooding risk and the weather events that we had in Auckland really meant that they had to pause, and the market was dislocated for 6 months, and that saw very extreme pricing going through. Now we've had to follow that through with pricing back to the consumer. The good news is that seems to settle, and certainly in our renewal that we just completed on the 1st of July, we saw a far more constructive approach to New Zealand risk, and in the discussions I've had with global reinsurers in the last couple of weeks, that's continuing. So it's a better story than it was 12 months ago, but the reason why there's a slightly increased elevation of premium in New Zealand relative to Australia has just been those events in early 2023.
Do you recognise that insurance premiums increasing to the degree that they have and the contribution that they're making to generalised inflation in this economy, it's keeping interest rates higher? It's one of the biggest contributors to CPI in this economy. Do you recognise that that's kind of making our economy worse right now?
I absolutely do, and you know, it gives me no pleasure to have insurance inflation sitting above the consumer price index levels of inflation. Now, that always is going to be the case in an environment like this, and it goes back to this global dislocation in reinsurance markets. That's driven up insurance premiums at a greater rate than underlying inflation. Now, of course, we have construction costs and supply chains, and motor insurance has been particularly problematic in both Australia and New Zealand. So it gives me no pleasure that insurance inflation is sitting above CPI. It's uncomfortable, but it's necessary in terms of having a sustainable insurance market going forward.
So how do you think about that premium pricing going forward then? The increases that we've seen to date, are they playing catch up, or do they also cover for some future inflated increase costs as well?
No, I think we look at input costs annually. So obviously we're dictated by the level of inflation, the costs of repair, things like labour supply in repair chains and smash repair centres and those sorts of things will always flow into it. I think the more that we see stability in the reinsurance markets, the less requirement is for reinsurers to price back to us, and therefore the less requirement for us to pass through to the consumer. So I'm hoping that we're going to see insurance inflation and CPI start to get an equilibrium, and that will happen, I think, over the next 12 to 18 months.
You mentioned in one of your earlier answers that you've just been overseas talking to European reinsurers, I believe. What are they saying? Are you having to negotiate with them to keep covering this country and Australia?
Oh, I think that was probably last year's discussion. There was a concern that I had that they would walk away from New Zealand particularly, and as a sort of purchaser of insurance, we buy insurance for both New Zealand and Australia. So that's a big benefit for New Zealand in the context of us being able to buy a package of reinsurance and apportion it appropriately between the two countries. The good news is that they're significantly more constructive now than they were 12 months ago. I think the good news is that we're able to buy more cover than we were last year, and that's good. We were able to supplement New Zealand through internal reinsurance arrangements, so that's been good historically. But I'm very positive that that constructive approach we saw at the last renewal will continue through the next 12 months.
They may have considered walking away from New Zealand. What made you come to that potential conclusion?
Oh, that wouldn't be us walking away from New Zealand, but the global reinsurers, because they whenever they see a risk that they hadn't modelled, they take a point of pause and reflect, or that they price it to a point where it becomes unaffordable. So, look, I think it was a sort of a natural reaction to something that they hadn't anticipated, and they hadn't anticipated cyclones in Auckland or flooding events of that magnitude. So when that happens, it's happened in Australia various times as well, in Queensland after the floods in 2011. So it's sort of a natural reaction that until they understand something, that they either take a very punitive approach to pricing or they step back from the risk. And reinsurance is a demand supply. You know, the more capacity you get, the better the pricing is and the more cover you can buy.
So it sounds like you almost had to go over there and talk them off a cliff.
Well, not so much this year, but 12 months ago, yes, we had to continue to let them understand how those events, while they hadn't been modelled precisely, were within the sort of range of things that possibly can happen. And we're all dealing with climate change. There's an imprecision around climate change. We're anticipating, more frequency and severity of large weather events. We think we've modelled it well and we can manage it well.
So what kind of conversations have you just had with them in the past few weeks then? If it's
I think it's about making sure that, what's happened globally is that there's been a transference of risk between the global reinsurers and the primary insurers. So we call it's a very technical point, but we call it attachment point. It's effectively, like your excess on your home, how much we pay versus how much they pay in a big event. And that doubled for us in the past 2 years. So what that has meant globally is that there's been a similar sort of level of events going on around the world, but the costs have been more borne by the primary insurers as opposed to the reinsurers. And I guess our discussion with them has been around pricing. We think pricing should start to come down on some of the covers that we offer. And we think that there should be availability of sort of what we call aggregate covers or volatility protection covers so that we can manage the larger volume of smaller events more effectively.
How accepting were they of that argument, Steve?
They're reluctant to accept things at first blush, but at the end of the day, it's a demand and supply equation. So we're seeing more capacity coming in. That creates more competition for programs like Suncorp's, which is one of the biggest reinsurance programs in the world. And so I think we benefit from, in terms of both price and availability when, alternative forms of capital come into that market as they are now.
I was looking through your profitability measures and there was one that stood out to me purely because, forgive my ignorance, but I actually didn't know what it meant. The UITR, the underlying insurance trading ratio. It seems to me like that's a measure of your margin, kind of like how there's a NIM and net interest margin for a bank. Yours is sitting at around 11%, which is midpoint of the range that you wanted at between 10 and 12. Can you explain to me what that measure is, why it is at 11% and if you're happy with that figure?
Yeah, it's one of the anachronisms of insurance. In other words, we create all these underlying metrics which are to normalise our business back to a set of principles. So effectively what it does is it normalises for, when weather exceeds or underperforms relative to our allowances. Investment markets are a big part of an insurance company, so it normalises back to what a normal set of investment market criteria might look like, and we often get releases or strengthening from prior year reserves. It takes all of that noise out and comes up with a sort of margin outcome, which then translate to the sort of returns on capital that we expect to deliver so that we can sustain a private insurance company in the public market. So that's what the measure is. It again sort of normalises all the noise and gets it back to a metric that people sort of understand and can consistently measure over time. So we have a target of between 10 and 12%. We're at the midpoint of that range at the moment. In periods gone past, we've been below that as we've sort of started to recover from the reinsurance costs that have gone through. Our target is within that range, and we think it's an appropriate return to keep our investors, focused on what we need to do to create a useful public market traded insurance company. But it also provides us with some certainty around how we're going to roll out premium and policies for the future.
The reason I ask is because looking at that, given it is, kind of within your comfort range, within your target range, right? Even though insurance companies like Suncorp are talking about higher reinsurance costs, higher expenses, your profitability measure is actually looking pretty good.
Oh, at the moment it is, but I'd make the point, and I'm going to go back to an Australian example now around, and there'd be similar examples in New Zealand. Our home insurance portfolio in Australia over the past 5 years has averaged a return on capital of 5%. Now, that's not a fantastic response when you can actually get a term deposit in Australia that gives you 5%, and if it's under $250,000, it's guaranteed by the government. So my question to an investor would be, why would you invest in an insurance company if you can get that appropriate level of return in a term deposit? So we need to get returns greater than that to make it viable, viable private insurance company. So, there's swings and roundabouts, there's ups and downs, there's long-dated cycles, short-dated cycles in insurance. It's very complex. But we think that sort of return is appropriate for what we need to deliver for our shareholders, and ultimately that allows us to deliver good products for our customers.
And it seems like the only real way to make a return, to make money in this industry, is to continually hike premiums to recover increased costs or is there also a little bit of efficiency gains?
Look, I think we have to continue to improve the efficiency of our business. So it can't be all just pull a price lever and, because we will just lose the confidence of our customers if we do that. So it's all about us. We can be more efficient in the way we manage claims. Reducing the duration of claims reduces the cost of claims. We can be more, innovative around the way we offer policies and the products that we offer to our customers. And we've got to make use of things like AI and digital to bring down the costs of serving policies within our business so that we're more efficient and that we can contribute to the returns as opposed to just have price as the only lever available to us.
Insurance policy availability. You've mentioned climate change. How are you thinking about insuring homes that are in low-lying areas or on the edge of cliffs in this country? Because we have built in all of those areas. We've heard from the likes of Tower Insurance, to bring up your competitor. They've publicly said they're moving to risk-based pricing, and they're out there talking about managed retreat. Are you in the same mind?
Yeah, look, I think we're all moving to risk-based pricing now. So when we talk about averages, that doesn't reflect the fact that some of the people who've been built or bought a home in an area that should never have been allowed to be built in are getting increases well above those averages. And there's an obligation, I think, not only on the government, and we talk a lot about what the government needs to do around managed retreat and, sort of subsidising and supporting people to move, subsidising and supporting people to improve the resilience of their home, but there's an obligation on the insurers as well. Our policies in some cases are embedded 20, 30, 40 years ago, and we've got to contemporise insurance. We've got to make it more, sort of modern in that sense. We've got to try and find ways of keeping people in the insurance market. That means we've got to come up with new products that meet people's needs and provide appropriate levels of cover, even if it's just base cover, so that people don't exit the market entirely and become either uninsured or at high risk.
It feels like we're looking at that as our future though, right? That given the places in which we have built historically, as you mentioned, the pricing of policies for those areas will become so high that people just won't be able to afford it. So that insurance giants like Suncorp will say, well, we didn't pull out, but rather people just couldn't afford it. Is that where we're heading?
Well, I think there's the affordability issue is a challenge, particularly in those environments. And what we've got talked about regularly is a 4-point plan that's improving government infrastructure, stuff that the government can build to make things more resilient. And there's various examples of that in Australia, and levy banks are particularly one where you can put a levy bank around a community and reduce the cost of events and bring the insurance premiums down. Subsidising people to take action in their own homes. For example, in Australia particularly, we can subsidise people to put solar panels on the roof, but we don't subsidise to allow that roof to be battened down so that it can handle a Category 5 cyclone, for example. So some of our subsidy arrangements are wrong. We continue to build in areas that we shouldn't. There's this desire to get more housing in, and we're just compounding the problem that we've had in place for the last 100 years. But the other one is taxes and charges. In some areas of Australia, for example, and I know it's similar in New Zealand, 40% of a home insurance premium goes in taxes and charges, whether it be emergency services levies, stamp duties, goods and services tax, earthquake commission levies. This compounding effect of taxes and charges on insurance premiums is contributing to the affordability challenge. We've got to deal with all of these things, and insurers have got to step in and start to think about how we make our products more contemporary.
You're about to become the chairman of the Insurance Council in Australia. Congratulations on that appointment, Steve. They talk about in Australia this thing called the protection gap. It's effectively the uninsurable part of the market, right? Swiss Re, a reinsurer, priced that at US $12 billion in the decade to 2024. Do you have any concern about that growing? And especially in New Zealand, given that insurance affordability, or rather unaffordability, is becoming a growing concern?
Yeah, I do. I certainly think that there's a subset of our population, both in Australia and New Zealand, whether it's 2 or 3%, or in some areas it can even be greater, where that protection gap is just widening and it's getting harder and harder for people to afford to get insurance and therefore become either underinsured or non-insured. And so I think all of the things that we need to do as an industry need to align with all of the things that governments in both New Zealand and Australia need to do to improve the resilience of our communities, to mitigate the effects of weather, to get the costs of insurance down through taking taxes and charges off, and us innovating around new policies. So I think we can all point the finger at someone else, but we've actually got to work together. And that's one of the key things that I'll be bringing into the Insurance Council. I know the insurance industry in New Zealand is of similar mind in terms of coordinating our resources better, making sure that we're working collaboratively with government. We've got to step in into the political domain and make sure that we're giving the government solutions as opposed to just sitting back and just letting them do what they need to do.
Look forward to seeing it. Thank you so much for your time, Steve. Appreciate it.
Thanks, Madison. Thank you.
Thanks for watching Markets with Madison. If you enjoyed this interview, please hit the like and subscribe buttons below. I do all of the research for these episodes myself, so your support means a lot. I always love to hear your feedback and ideas, so please drop any thoughts in the comments below. Now go put your money to work.